So I know there's a lot of talk right now about rents are just going to keep going up forever and ever and ever, but they've actually been going down. Toronto went down 5.6% last year, and Vancouver went down 7.8%.
Have you been thinking about buying your first rental property for some time, or do you already own a bunch of properties? Well, fellow investors, you found the right location to listen and learn from others' successes. Welcome to The Very Real Estate Effect with your host, Axel Mont-Saint-Jean.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing in Quebec. And today, it's a pleasure and an honor to have my friend Jeffrey Kirton, urbanist and real estate investor, back on the show. Hi, Jeffrey. Welcome back on.
Hey, Axel. Pleasure to be back.
Just before we started, we dove into a conversation that is definitely worth sharing with everyone about performance, about projects, about the financial viability of projects, whether they're large and small. And that's all based on demand and on rents. And we've seen a decrease in rent in new constructions. There was an article in the paper a couple of weeks ago in La Presse saying that people shouldn't be expecting affordability to go down just because we haven't been building enough, and we need more units, and the ratio between the two is price, and that's rents.
Yeah.
And so you found some very interesting figures about the increase in rents throughout Canada.
Yeah, so pretty cool. There's it's the first time that StatsCan and the CMHC, they did a partnership together about rental data. Before, what they would do they would do a survey of renters and say how much do you pay for rent, but they would get these people living in a rent controlled apartments for the last 10 years who were paying $680. When I was at the nonprofit to get subsidies, we'd have to be 30% or X% below the median rent. In 2021, when I looked it up, apparently the average rent in Ville-Marie for a 3-bedroom was $1,028.
That's impossible. That's literally impossible.
I remember working there. The guy doing the survey called me to know what the rents we were going to charge were going to be. And I was like, you're the guy who makes this data? And he was like, I know it's out of whack. So what they did this time is they did the asking rents, and they scraped data from all the
from the market.
Sites. Yeah.
Okay.
Kijiji, Craigslist,
the
Facebook Marketplace.
Yeah, Centris, wherever it gets advertised.
Yeah. So it's pretty telling. Some things, some highlights about it were that the lowest rent in the country for a 2-bedroom is in Drummondville.
Wow.
Yeah.
In all of Canada, it's in Drummondville?
In all of Canada. I was reading the report. I thought, I was like, is this about Quebec? Because they talk quite a bit about these little towns in Quebec, but it's also the one that's gone up the most. So it went from $600 in 2019 was the asking rent for
a 3-bedroom. For a 2-bedroom, wow.
And now it's $1,200. But
okay, so
Sherbrooke's kind of the same. It used to be $12. Now it's $1,250, and it used to be $660. Let's go. We'll go from top to bottom.
Sure.
As most people know, Vancouver
and Toronto are known as the highest. Yeah.
But there's some telling data. So Vancouver, $3,170 for a 2-bedroom apartment. That's a lot of money. That's the average asking rent.
Average asking.
Average.
Jesus. Yeah.
It's a supply constrained market. They have laws that protect residential developments outside the town. Green belts, people used to say it was a great thing. Now it's like, I don't know. Toronto number 2, $2,690. Victoria, which used to be kind of like a safe haven for people leaving Vancouver to get more affordable, $2,680. Number 3, Ottawa number 4, $2,490. This is just from Q1 2025. And Montreal, actually further down the list, number 17 at $1,930 asking rent.
So Montreal is 19th in the country.
17th position.
17th, sorry.
1,930.
17th.
What's really telling, I found, is between 2019 and 2024, they have... in Montreal, it's gone up 71%. The previous in 2019, just before COVID, was 1130. The good old days. Like I used to be a tenant. I spent For 1,600, I had a 8.5 with like 5 bedrooms. I shared a room with my girlfriend. We paid $220 each for rent.
It was a commune.
Yeah,
we didn't know how with other people.
It was big and nice.
Yeah,
it was big Victorian.
For 1,100.
It was 1,600, but then with all the other 3 other people paying 400. Like I could have lived for free if I wanted to, but they're my friends. So.
So you only charge them a little bit.
Only a little bit.
Yeah.
So Montreal has gone up 71%. And here's where, to me, it gets interesting. In Toronto, since 2019, it's only gone up 5.1%. That sounds like, 5%, decent. No, like that's not including inflation. That's like raw numbers. So technically, like since 2019, inflation, like to do your groceries and everything, that's all gone up by what, 35?
I was going to say 25 to 35%, something like that.
Yeah. Vancouver, a bit stronger. It's gone up 27.3. And for both the big markets, Vancouver and Toronto, the peak was actually Q3 2023. So I know there's a lot of talk right now about rents are just going to keep going up forever and ever and ever, but they've actually been going down. Toronto went down 5.6% last year, and Vancouver went down 7.8. Where this is important as where you kind of see, like as a city planner, I see a bit of a flattening. And my hope is that, we have these 3 big cities that are exciting where you can get your groceries by foot and you don't need a car to live.
Which city? Vancouver,
Toronto,
Montreal. Okay. Yeah.
And, there's only so many. So there's a lot of people want to live there. You saw the same thing in San Francisco during the tech boom. It's a great, fun city. But then all of a sudden, you had all these Google workers and people just working like a nurse couldn't afford to live there. Right?
Exactly. And the rent demand went up. So the rents went up and then other people can't afford it.
So maybe what my hope we see kind of a flattening. Canadians are finding it too expensive to house themselves. So they're going to move. And maybe it's a chance now to seize the opportunity to kind of build mixed use, vibrant communities. They already have a traditional downtown. It's just half the stores are boarded up. So maybe if you build some housing around there,
in the smaller cities,
small medium-sized cities. Think about like Granby, Quebec, or
it's boomed.
Brandon, Manitoba.
Granby, Chambly, some of those smaller tier cities have had tremendous growth. Sure. And the surprising thing, as you mentioned, is that the rents are lower, but they're not that much lower. I mean, Drummondville and Sherbrooke are the perfect example. Over a 6-year period, it went from 600 or 660 to 1,200, 1,250. Those are almost Montreal prices in a way.
Montreal 2019, but I see your point. I think it might continue. I can't really picture, and then this is more investor point of view. Like why when I bought my triplex in Farnham, 3 tenants paying $780 for 1,200 square foot, air conditioned with a heat pump and a nice yard and 2 parking spots. There's only one way to go, but up without any forcing or anything, just naturally. Anytime a tenant changes, so there's that, and you're seeing a true stabilization in the rental market lately. And so as an investor, when you're doing your pro formas, you usually have a line when you're calculating the IRR, and you plug this little number in the back of it. That
rent growth?
Rent growth, 1, but your exit cap rate. So in 5 years, what do you think the cap rate's going to be?
Yeah.
And you can make these like 25-page pro formas with all these fancy numbers and try to impress someone. But in the end, it's this one little line in the data that's the assumption, and this is where you kind of need a bit of a sixth sense, is to know where the rents are going to go. So let's say if I bought a triplex in Montreal in 2019 versus buying a triplex in Drummondville in 2019, in one, it's the rents have increased by 100%, and the other, it's gone up by 71%. So Montreal was a great investment, for sure, compared to someone who was in the Toronto, Vancouver market.
And that's the thing. And it's always so relative, because we look at this in Quebec and we say, oh my God, Sherbrooke and Drummondville had so much growth. And then there's people from Toronto that love to come and invest here because they said, oh my God, just in Montreal, you've had so much growth. And so looking from an outside perspective, it's always interesting to see how relative it is.
Yeah. But just for fun, I recommend anyone just go to some random towns, especially in the US, and just look at property values. And it's just
Oh, I know, it's insane. You hear, or even on other podcasts,
$5,000 house.
exactly. And I bought a house over there for 32,000, and I rent it for 1,000 a month. And I'm like, what?
Yeah.
How does that work?
Yeah, in Richford, where I have my cabin, you can buy this like historic building that used to have like a mill, and it could be this $10 million glorious property, and it was for sale for like 180,000 because the market rents and everything just don't justify the renovation costs.
Basically,
so it's essentially worthless almost.
Yeah. So now seeing these figures for the growth, that happened over the last 6 years, what does that mean for investors and for developers?
You should really, get a good grasp of the data and maybe try to think a little bit outside of the box. Maybe if we're zooming in on Montreal, instead of buying in the plateau when it was at its peak, try to pick that next best neighborhood that's going to be cool, depending on the timing of your project. And like Verdun used to be cheap, not cheap at all anymore.
No, not cheap at all.
But it used to be, right? So if you had, you have these dynamics nationally, but also within a city, within a neighborhood, and try to kind of pick that next cool neighborhood or city.
Yeah.
Another thing is public investments. That's the condo where I live. We bought it in, was it around 2021? It's right next to Plaza Saint-Hubert.
Okay.
And do you remember around 2021? Huge construction.
Yeah.
And it was like a no man's land.
Yeah.
And they had that ugly marquise before.
Yeah.
And so you have the government, the invisible hand, injecting $25 million into the street, and sure enough, what happens?
It popped.
Yeah, it pops. Houses are nice. Beaubien is like a hot spot. All my friends who live in the plateau, there's a lot of French people. Like they now when we go to Beaubien, whereas before it used to be Mont Royal, right? So they just actually opened a new Place Boyer there on Sunday. They just unveiled. It used to be a parking lot and made a nice little spot. There's actually a kiosk with a sort of a taco stand in there. It's very cool.
Yeah, good opportunity for redevelopment.
Yeah,
and for changing those neighborhoods. A couple of weeks ago, there was the Montreal Real Estate Forum, and in one of the panels, coming from some financing gentlemen, they kept mentioning how when we analyze properties now, we are extremely conservative on rent growth, and they say we've had a big upside over the last 5-6 years. And so now whenever we get pro formas for projects where they anticipate 3 to 4% per year for the next 5 years, we basically scrap it right off the bat. So as you said, it is expected that now there will be a bit of a taper off and flattening for a couple of years, just for the market to absorb all this already built-in growth. Yeah. And then we'll see in a couple of years. And then it's going to be interesting as a conflicting force with, we haven't been building enough. There is still increasing demand. What is that going to do on rents? Is it still going to put a lot of pressure on the upside or flat?
Actually, a new metric, it's not new, but a metric a lot of skilled developers actually use is called yield on cost. So you take how much it's going to cost to do the project, then you take your net revenue and you divide it, and it kind of takes out all these projections as if you had some crystal ball to know what's rent's going to be in 5 years or what are the cap rates going to be in 5 years. And what it does, it'll give a number around like 5 to 10%, and you want a percentage that's a bit higher than what you would get in a more traditional investment. Yeah, and it takes interest rates and everything kind of out of place, so you have a bit of an apples to apples.
And you said, how is that calculated? You said it's the construction cost?
So, pretty sure it's yield on cost. So you take the net revenue. So let's say I build, let's take my sixplex in Bedford that I'm building now. So it's going to make 110,000 gross revenue, about 75,000 net revenue. It's going to cost 1.7 million to build. So
so you do the math.
I'm usually pretty good, but let's say, that would give about 5 and a bit percent.
Yeah, 5.5, 6, somewhere around there.
With this metric, I don't think it's the greatest deal in that perspective, but my theory is that 3-bedroom apartments, I'm going to be renting them out for between 1450 and 1600 a month.
Mhm.
And to me, there's only up.
Yeah.
I think we're going to see kind of, when people left Vancouver to go to Kelowna or Victoria, I think Farnham, it's got some wineries opening up. I really like the market. I had friends they were artists and they lived in the Mile End, and there's this gorgeous industrial building along the river. There's like a mill with a waterfall.
Wow.
And you see all these cool businesses, like it feels like the
Popping
plateau
up.
15 years
Yeah.
ago. Yeah. The cidery factory.
And there's been a huge move. Like a lot of people from the cities have been leaving to go to a more rural environment, and
remote work, right?
And remote work now allows it. And maybe they come into town 2 days a week or what. And
maybe it's gonna come back a little bit. Maybe it's gone too far. Like I think one that's I wouldn't want to be in the shoes of someone who had a condo in Montreal and said, let's buy a $600,000 chalet way out of nowhere, and we
moved over there permanently.
Or a second home, even worse.
Mhm.
And they bought it with 1.9% interest rate, and now they're going to renew at 5%. And
Well, that's exactly what's happening
they can't rent it out anymore. People used to during the pandemic. It was impossible to book a chalet. Now it's a bit saturated.
Yeah. And think of all those who got out of the city, moved an hour and a half away working for their firm, and now their firm is saying you need to come back 4 days a week.
Imagine? Yeah.
Well, this was bound to happen. We knew this was going to happen. And Ian Quinn from Brasswater at the Real Estate Forum said, I specialize in industrial and commercial, and I found it ludicrous that people are complaining downtown that the offices are empty, but yet real estate companies haven't forced their employees back in office. How do you expect other firms to do it if you're not doing it yourself? And there's a bit of a silence in the room, and I was like, well, damn right.
Yeah. Oh, man. I used to, when I worked at Six, my last job, I love going to the office.
Yeah.
I love
for
changing and everything. But, my wife, different strokes for different folks. My wife, she's like, goes to the office once a week, and she's really happy to work from home. But I mean, you're right, though. I think I was reading this book, Mastering the Market Cycle, and it talks about how there's going to be, the economy is going well, and interest rates are low, lenders are lending money, people are overbidding for stuff. So everyone's like, oh, let's capture that value. So then, but the difference between stocks and real estate is especially if you have a Pepe Semoir or something, it's going to take 5 years by the time it's on the market. So you have to plan the project today for the market in X amount of years, depending on the complexity. So they say what happens after that, things cool off. You have a lot of things coming to market. There's a downturn in the economy. But then you still have all these projects that were planned during the boom, and they're coming to market. So like they're going to be coming onto the market gradually for the next 3-4 years in the development pipelines. And then I think we're at this moment right now, is they see all the things coming in. They see rents not going up, housing prices flatlining. Toronto, people are abandoning their construction sites, going bankruptcies left, right, and center. And so it's the part where everyone's going to stop developing. And like you said, there's the risk that there's not going to be enough. And then all of a sudden, one day the economy is going to get better. Yeah. And there's going to be 2 years from now out of the pipeline.
Yeah.
And people are going to need a place to live. And then the overbidding is going to start. But there's going to be a constraint because not enough people plan their projects. And then the bidding and the lower rates and the projects are going to start up again.
And there's such a time lag. And that's the thing, like to get a project now on the market, you started 2 years ago, but the conditions were different. Yeah. And that's really difficult to be able to, you got to keep pushing when it's difficult so that when you go through it, you actually deliver at the best possible moment. Yeah, but that's difficult.
I remember some developers around, let's say 2018, when Montreal, it used to be really, really cheap, and compared to other markets, and they're selling, in brand new condos for like $185,000, and all of a sudden, like when they did their pro formas, they were like, had we just sold a year or two later and done nothing with it, we could have sold it for $240.
And big changes.
Yeah,
and that's why it's important to stay informed. It's important to read. It's important to keep track of the news. This is I will put the link of that database that you mentioned at the beginning in the show notes. Yeah, and I highly encourage people to go look at it. Guys, you've got to stay informed. You got to keep listening to this podcast and read the paper and plenty of other good sources out there for you.
Yeah, take a look at the report, guys. It's the first one that actually used real asking market rents, and there's some pretty telling stuff there.
Thank you for bringing it up. This is really good information, Jeffrey. It's deeply appreciated. Thanks for coming back on the show today.
My pleasure, Axel. Thanks.
And for everybody who's listening, as usual, share this episode with a friend who could benefit from this conversation. Keep researching your market. I keep saying it. It's important more than ever. And I'll talk to you next week. Thank you.